$600 billion. That is the staggering amount of wealth that was literally wiped out of Asian markets in just a matter of days this week. And, while that might seem like a distant event happening half a world away, it is actually flashing a massive red warning indicator for everyday investors right here at home. In today's Explainer, we're going to explore exactly why the memory triad earnings could pop the AI bubble for good. We'll break down how a localized market crash in South Korea, which was driven by these memory chip makers, might actually be a sneak preview of what's coming for the broader U.S. stock market. Section 1. The canary in the mine. So to understand the macro risks we're facing, we first need to look at South Korea, which has essentially acted as a fast-forward preview of the U.S. market. Now, what's really wild here is the sheer concentration risk. Just two memory chip companies, Samsung and SK Hynix, make up a massive 56% of South Korea's entire stock market index, the KOSPI. They effectively transformed a broad, diversified index into one giant, highly centralized bet on AI memory chips. And as you might guess, that kind of concentration is a massive liability. When U.S. competitor Micron showed some volatility leading up to its earnings, investors got spooked. That uncertainty sparked a devastating 25% plunge in the Korean market in just 21 days. It culminated in a brutal 10% single-day drop that they're calling Black Tuesday. To put that in perspective, a 10% drop in a single day here in the U.S. would be the third worst day in American financial history. Section 2, Anatomy of a Margin Call. Let's look at how this all builds into a systemic issue when you add borrowed money to the equation. The crucial detail here is that millions of retail investors in Korea weren't just using their own cash. They were using borrowed money and leveraged ETFs to bet on these chip stocks. This set an incredibly dangerous trap. When you buy stocks on margin and the price drops too low, your broker issues a margin call. They basically demand cash immediately, or they automatically sell your stocks for you, no matter how much money you lose in the process. This triggers what we call a doom loop. First, stocks drop. Then, brokers demand cash, which leads to forced selling to cover those loans. And guess what happens next? All that heavy selling pushes the stock prices down even further, triggering the next wave of margin calls. It is a vicious, self-fulfilling cycle. Because of this exact structural mechanism, 1.2 million accounts were hit with margin call thresholds. That means roughly 1 in every 30 people in the entire country got wiped out of massive amounts of wealth almost overnight. Section 3. The U.S. AI bubble connection. So the big question for us is, are we walking right into this exact same trap in the United States? Now, obviously, the U.S. market is more diverse than Korea's, right? But we are still seeing historically extreme concentration levels. Sure, we don't have 2 stocks making up over half the market, but just 10 companies currently make up nearly 40% of the S&P 500. If those heavily weighted tech giants stumble, they're taking the entire index down with them, even before any real panic selling starts. And what exactly is holding up those top companies? Well, the entire global market is effectively being supported by just a handful of massive tech players pouring insane amounts of money into AI. Microsoft, Google, Amazon, and Meta are on track to spend $725 billion on AI infrastructure in 2026. It's essentially a closed loop where one giant company's spending becomes another company's earnings. Compounding all that concentration risk is the fact that U.S. margin debt has absolutely skyrocketed to $1.5 trillion. That is a historic 4.5% of our GDP. People aren't just buying into this AI rally. They are borrowing heavily to chase it, which looks a whole lot like the setup we just saw play out in South Korea. Section 4. The bullish counterargument. As an impartial explainer, it's vital we look at the structural differences that support a more optimistic view of the U.S. market. So major institutions like Goldman Sachs are actually incredibly optimistic right now. In fact, they recently raised their S&P target to 8,000. Their main argument? Unlike the dot-com bubble, where companies were running on pure hype and zero revenue, today's AI infrastructure companies are printing actual massive profits. Earnings growth has been stellar, and they are largely funding these big AI buildouts with cash, not junk debt. On top of that, the U.S. market is built like a fortress compared to smaller exchanges. We benefit from deep institutional buyer pools, including pensions and trillions in automatic 401k investments that buy in consistently, regardless of price. Plus, we're seeing this rally safely broaden out to smaller companies, which is exactly the kind of healthy market behavior you want to see. Section 5. The bearish warning signs. But despite those strong fundamentals, we cannot ignore the mathematical realities that threaten to pop this bubble. Let's look at the historical track record for all that borrowed money. Every single time, U.S. margin debt has reached an extreme peak relative to the size of the economy, like in March 2000 for the dot-com bubble or July 2007 for the subprime crisis, a major market correction has historically followed almost immediately. And today, we're sitting at those exact same record levels. Add to that the fact that the financial math is getting really stretched. Right now, AI hyperscalers are shelling out $1.57 in capital expenditures for every single dollar they generate in operating cash flow. They're spending heavily on the promise of AI before seeing the cash returns. If they decide to suddenly cut back on that spending, it could absolutely collapse the earnings of the chipmakers supplying them. The reality is, the market right now is priced for absolute perfection. If earnings simply disappoint just a little bit and market expectations return to their historical norms, the S&P 500 could easily see a 25% drop. And remember, that's without any major catastrophic event, panic, or even a recession occurring. Section 6. How to protect your money. So with these two very different market realities laid out, let's establish an actionable plan for everyday investors. The best way to navigate this tricky environment is to play it smart and safe. Make sure you have a solid 3 to 6 month cash emergency fund built up. Broadly diversify your portfolio so you aren't completely exposed to tech. And most importantly, strictly avoid using leverage or margin debt. You want to make sure you are never ever caught in one of those doom loops and forced to sell during a panic. As you evaluate your own financial strategy, I want to leave you with this critical thought. Ask yourself, does the undeniable, world-changing potential of AI technology truly justify the historical premium the market is demanding we pay right now? It's a massive question we all need to answer for ourselves. Thanks so much for joining me for this explainer, and stay sharp out there.